You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
When it finally got down to about $1, I decided to buy the $4 call option 2 years out. Eventually, Antero got to $40. I sold most of my position probably in the mid-20s, unloaded the options shortly after that. So again, a life-changing return off of that stock. And there were a few others like that.
Welcome back to Mining Stock Education. I am your host, Bill Powers. And as the host of this show, I try to bring to you new voices with insights that can both encourage and teach you. And I think I've done that today with a new guest. His name is Sultan Ameerali. He's a self-directed and self-taught resource investor. I found him on Twitter at Sultan Ameerali. The hashtag, his website is also consolidatedrock.com. Sultan, welcome to the show. For the first time, you have a background in financial journalism. Tell us your story and how did you find your way into small resource stocks?
Thanks to you. First of all, thank you for having me on, Bill. And as I was saying to you before we started recording, I feel like I made it because I'm on Mining Stock Education. So how did I get started in mining stocks? So I think I've always had an interest in investing, and that started, I think, early on in my life because, I didn't come from a lot of money. We're a family of five, first generation Canadians. My dad was an engineer, but single income household, so everything had to stretch. And you become acutely aware as a child when people have the latest transformer and you don't. And so it was always a thing in my mind that I was going to make a lot of money one day, and I just didn't quite know how to do it. Got sidetracked along the way, ended up in journalism, and some people will probably know I worked for a large radio station in Toronto. I worked for a national news in Canada, CTV National News, and then eventually found my way to BNN, the Business News Network. That was in 2010. CTV and BNN are kind of owned by the same company. I was told, you're going to go over to BNN for a few days, a week tops. You're going to be there. We just need to help them out for a bit. I ended up staying at BNN on and off for about 8 years. And I think I did everything there. I did very little on-air work, but I was a producer of multiple TV shows there. Ended up working on their website, and then eventually into a layer of management doing sales and digital development of apps, data feeds, that sort of thing. And I got a good grounding in business journalism and a lot of guests running through that BNN green room. And I think the thing that taught me the most when I was there was one of my first jobs was to man the Bloomberg terminal. And so there's a function that some of your listeners probably know. It's called NI News, and it's just a stream of news releases and press releases. And the job was to take the interesting press releases and forward them onto the newsroom. And so I got to see everything that came in. I got to see what moved stocks, what didn't move stocks, things that were important that people missed. And it was probably the best education as a retail investor coming in cold that you could ever get, because I got to see everything. And I think from there, that kind of whet the appetite to start investing on my own. And I've always, I think you have to know your personality when you invest. And for me, I'm cheap, Bill. I don't like paying a lot for stuff. So, the idea of the bankrupt security, the distressed asset, when I was working at BNN in 2008, 2009, 2010, this was around the time that Bill Ackman was buying something called General Growth Properties that had gone bust during the financial crisis. And, a great trade, just an absolutely great trade. And he bought the equity distressed. He didn't even have to go down the ladder on the cap structure or buy any kind of debt or anything like that. Eventually, he spun out Howard Hughes Corp. General Growth got bought by Brookfield Asset Management. And I think at that point I was hooked. And so I started doing some investing of my own through the 2010s, mostly focusing on, I would say, I'm going to call it TSX detritus, TSX Venture detritus. So these were broken companies on the TSX Venture exchange. As some of your listeners probably know, not the greatest exchange. It can be highly speculative, particularly when you're talking about healthcare, various types of roll-ups, that sort of thing. And I did pretty well on that. And there were a couple that one called Patient Home Monitoring, another one called Holloway Lodging REIT. And those came to my notice because at BNN, we had a call-in stock show. And that also gave you a good gauge of what retail was looking at. And so stocks like these get popular. A lot of people call in. The guest will comment on it. And then eventually when they crash, the guest doesn't want to talk about it anymore, right? And so I found that could be a profitable hunting ground. Probably around 2017, 2018, that had kind of gone away. As you probably are aware, tech growth stocks had really taken off. 2015 was probably the last gasp of sort of the resource bull market, but a lot of chatter about commodities. And I did, to be honest, I really kind of avoided commodities up to that point. And I had made a point that I was going to learn how to do this because I did remember in the early 2000s, things like tech, Inco, Falcon Bridge, and just sort of seeing those in the news as a journalist, being taken out, taken over. And there was a lot of money to be made if you could get the cycle right. And so I decided that I was going to learn. And the way I learned anything, I was going to invest my own money and see what happened. And Bill, they chewed me up and spit me out. I didn't see them coming, right? And I lost a lot of money buying speculative mining stocks. And then at that point, I decided I have to learn how to do this properly. So I did three things. I reached out to people who did do it properly. How do I build a basic model? And I don't necessarily invest entirely off the model, but I feel like it's important to know how to do so that you can see how different costs affect what comes out the other end in terms of free cash flow. I read everything I could on Barrick and Franco. They're the biggest Canadian stocks in the sector, just to understand the drivers of their business, the things that they owned, why they own them, how they grew the company. And I think the other thing I did is try to subscribe to as many sort of paid services as I could. And that was an eye opener because, if we're being blunt, 95% of them were not great. And, understanding what the marketing was involved in the junior mining sector. And I think from that base, just sort of building myself up, I started off with keeping it simple, asset placed, things where maybe it's trading below the cash value and there was something valuable there. And then eventually work my way up to knowing enough to feel like I could talk to a CEO intelligently, get some sense of it, and then adding a different piece onto that, talking to people around the CEO. And then eventually, okay, the deposits in this area, I have some skills as a journalist. How do I find people in that area? And social media makes that easier. You can always go on LinkedIn and, in my case, the first time I did it, I found a mid-level manager for a mine in the Abitibi region of Quebec and just sort of reached out and said, hey, would you be willing to tell me about your job? What do you do? How does your day-to-day go? And, using those little pieces is kind of how I came to mining stocks and eventually developed the expertise and more importantly, I think the confidence to make some bigger bets and to really make some investments that quite frankly have changed my life.
Sultan, so one of my critiques of retail resource investors is that they take information from newsletter writers or from a show like this on the internet, but they never actually talk to management and verify the information. Any thoughts you can share here?
You have to talk to management. Now, I'm not saying you have to talk to management all the time. I actually think that it's better you want to talk to everybody around management before you talk to management. I kind of look at how I invest is probably a bit different than most. And I think it comes from my background. I don't want to invest off a straight model because I have no edge there. I mean, I have a math background. I went to school for math, but if this was math, then you and I wouldn't be making any money in this sector.
Well, narrative is more powerful than math oftentimes, can it be?
Yeah. And so I like to use what is called like it's basically the framework that's used by intelligence agencies. It's called the Mosaic framework. So you just get pieces from a bunch of different places and you put them together to assemble a picture. And based on that picture, you have to decide the probability that something is going to 10x, 20x, whatever your return needs to be. Understand that there is a probability with any mining stock that's going to go to zero. What's that probability going to be? And there's no such thing as a bad investment. There's a badly sized investment, and you have to size your investment based off of You look at the facts, you look at the patterns, and you see what doesn't fit. And I believe that in investing in a bank. I believe that in investing in a consumer products company, and I believe that in investing in mining stocks. It's very much a probabilities game. Like, we're talking about a sector that consumes capital on the whole, right? And the winners, there's survivorship bias here, right? And it's easy as a retail investor to get sucked into that survivorship bias. You have to go into understanding you're not going to know everything. And it's you have to size the bet appropriately for what you don't know. And so for me, talking to management is important, but it's not my be all and end all, because I have to also know when they're lying to me or when they're fudging something. And the only way to know that is to talk to everybody around them. And you can define around as, as any number of ways. But for me, what that looks like is I want to talk to people who've done deals with them previously. I want to talk to people who've maybe worked with them previously. I want to talk to maybe somebody, if I can, if it's a large enough company, who's mid-level in the company. I like to talk to people on the ground, actually doing the exploration. That's hard to do as a retail investor, and I totally get that. Talk to as many people as I need to feel comfortable with the investment. Then I'll go to the CEO.
You kind of sound like a job recruiter right now, the way you're analyzing it, because someone gives you an application, and then I know some of my relatives that worked in the military, especially when you were going for a high clearance, they would go back to your childhood friends, knock on doors, and ask about that person.
Yeah. There's a great book on this. It's called The Sleuth Investor. And he talks about what he calls sleuthing. And, Avner Mandelman, he's going through people's trash. He's talking to mistresses. And I'm not advocating talking to anybody's mistress. I'm not saying that, but talk to everybody who's relevant. And you will get a much better picture, so that when you go and talk to the CEO, you're intuitively going to know whether the person is being honest with you, whether they're holding something back. There are things that a CEO can't tell you, right? And that you have to intuit for yourself. Those things are going to be easier to intuit if you have a better understanding of the person who's across from you. And so I've made big investments talking very minimally to the CEO, but I kind of know what I need to know. At the very least, you should be looking through filings. And if you have questions, which you should, asking those questions and seeing what comes back. The only red flag I would, immediate red flag that I'm thinking of off the top of my head is if they won't get on the phone with you. If somebody wants your money, they should get on the phone with you, right? Now, understanding that with companies that might be a bit larger, that's an IR person, most likely, but somebody should be getting on the phone with you. And if they're not, why would you put your money there?
So what you just described is a laborious process. Do you do this for every single investment, or only investments over a certain amount?
Yeah. So it's, to your point, I do enjoy it. So, and I have a lot of, there's a lot floating around up here, right? I'm a pretty good user of CDAR. I know how to use CDAR.
The most unuser-friendly website on the planet.
Yeah. I feel like they changed it recently, so I'm going to have to redo my branding, but I feel like for a time I was a power user of CDAR. I knew how to use it really, I think, better than most. For a large investment, it's the works. I drill down, and I talk to everybody I can. Oftentimes, the company might be the last person I talk to. For other investments where I'm maybe creating a bucket, there's, I'll do a higher level a scan just to make sure everything kind of checks out. And I think it depends on, to your point, the amount of money that's at stake. And if I have done less money, I try to hedge my bet by position sizing again. I'll create a basket. And I tend to do this also with larger stocks, because obviously if I'm buying tech, nobody's getting on the phone with me if I own tech, right?
But don't you think investing in tech provides you less of a potential competitive advantage versus a small cap where there's a lack of information?
Absolutely. And I think if you're going to invest in something like tech, I bought it probably a few years back, probably in the $18 to $20 range. And you get these kind of buying opportunities with any large cap stock. Tech in particular, I kind of like, because if you remember in 2008, it went down to $3 and then it went up to 60. Now I think it's at 57 or 58 Canadian. I'm not selling that until Glencore gives me my $70. But that was something I bought at 18 and it just seemed cheap. And And this will happen time to time with large stocks, right? Something isn't being priced in. There's some sort of short-term blip, and it doesn't mean that it's a forever hold. I think in this case, it's something I plan to hold until it gets bought out. But to your point, information asymmetry is something that you can use with smaller stocks. Absolutely. It doesn't preclude you from buying larger stocks. At the end of the day, we're just trying to make a return. And where can you make the best return with the least amount of risk? And sometimes that's mining stocks. In terms of sometimes that's a bank stock. And to me, my floor is, being a Canadian, is probably about 11 or 12%, because that's generally the CAGR on a Canadian bank stock, a decent Canadian bank stock, between the dividend growth and the growth in the share price. So, I'm not in this to make 30 or 40% on a junior mining stock. I need to know that I can make 5x in 5 years, and there's a roadmap to doing that, or that I'm going to get a nice little income stream out of it, depending on the stock. Something like tech, to your example, I thought that was a good buying opportunity, where, $18 probably worth closer to $40. We're seeing now that as QV2 comes online, that there's a lot of interest in buying that stock, and even the coal assets. I think when this gets broken apart at the end of the day, I don't know when it's going to happen, and maybe the timeline doesn't work for me, but to me, $70 Canadian is probably the floor.
So, Sultan, if you would hold on to a stock for a 5x anticipated in 5 years, do you also do shorter term trading within the sector if you see an opportunity?
Yeah. Something drops for any number of reasons. And this is where, if you have your mosaic framework and something drops for a reason that doesn't make any sense, you can step in and buy. I think tech maybe fell into that at one point. That started as a short-term trade, and the more I was in it, the more I liked it. One that I really liked, that I think is similar, it's become a core holding for me, is Altius. I'm sure you're familiar with Brian Dalton. That got down to $9 a couple of years back. I can buy a junior miner, copper play or something, that I can buy Altius, right? And it just seemed like a no-brainer. I'm still holding it to this day. And those sort of large stocks provide a backbone to my portfolio. And so I've been lucky, and I've been blessed that junior mining stocks have done well. But in terms of capital put in, it was 75% in large mining stocks, 25% in the junior miners. Depending on the day or what's happening, based on what everything is worth these days, I'm now 60-40 on the junior mining side, and that's because everything's outperformed. But that doesn't mean that my Altius hasn't gone from 9 to probably about 20, or that tech hasn't been close to a 3-bagger. It's you got to pick your spots, and just because you have an outlook on a commodity, it doesn't necessarily mean that a junior resource stock is the way to play it. And this is all about making sure that you stay in the game. The last thing you want to do is, and I'm sure you and I have both seen this, Bill, where somebody puts their life savings into junior resource stock X, and
the scariest emails I've gotten, Sultan, were when people are saying, Bill, I'm coming up on retirement and I don't have enough money, and so therefore I took a large chunk of what I have into junior mining stocks. And I was like, oh no. It's like, I'm sorry you don't have enough money for retirement, but like, you might get 8 times your money in 3 years, or you might get 1/10 your money in 3 years. So just like, be very careful with that.
Yeah. And I think people look at these inspirational stories of people who went all in on mining stocks, and there's survivorship bias there. What you're not seeing are the people who went all in and didn't make it to the other side. And you and I were talking a bit about this off air, but a lot of the people who kind of went all in, they would have been fine if they didn't work out, because they had other skills. They probably could have gone back to whatever it is they were doing beforehand, right? It wouldn't have been the end of their world. And, I don't think it's in anybody's best interest to, I know for me, as my profile's kind of grown on Twitter completely organically, and, it surprises me to this day that, what the most gut-wrenching emails I get are the ones about people saying, you mentioned the stock and I put $50,000 into it, and now it's like, what do you think of it? Or constant messages about the movements, the day-to-day movements. And you try to be nice about it, and they're probably the same as you. And it's like, I don't care about the day-to-day movements on a stock that, if nothing's happened, then I don't care. And my life is designed around doing as little work as humanly possible when it comes to, I want to do the work up front so I can buy it. And then that way I know if something fundamental has changed, I don't hesitate. I am out, right? But I also know enough to know that, okay, well, that's a fixable problem. Maybe I want to buy more. Okay, that's not a fixable problem, but I don't want to sell. Maybe I'm gonna monitor this stock. And the way I buy junior resource stocks is I use an averaging down system where I'll buy a bit up front. The second time I buy, I'll maybe buy double the amount, and it goes in orders of magnitude, so that by the last buy, if it hits that marker, I'm buying 50% of my position. So by the time, something that I talk about on Twitter, by the time I have the full position, because I know myself well enough to know that, I'm cursed, and whenever I buy, it's going to go down right after I buy it. So
you buy in tranches.
I buy in tranches, but I weight the tranches. I don't weight the tranches equally. As the stock goes down, if I've done my work and I'm correct and my thesis still holds, I'm buying more on the way down, and I weighted it so that that last tranche that I buy should be 50% of my full position. Now, sometimes that can work badly. If I get it wrong and I completely miscalculated and it's a full position, that can hurt, because then I average, but it hurts less because then, my stock, my price has dropped. And so I find it's a good way for me, that works for me, to get my full position, not pay full price, get around sort of the mental barriers around, I have to have it right now. Stock doesn't know I own it, right? So I can own a little bit to kind of satiate that for me. So I have a bit of the position, but still not just buy everything right away, and, can kind of assess. And sometimes it's worth buying it just so I can track it. And then while I'm doing the due diligence, if I'm really excited about it, but without blowing myself up if I bought it and then something came up.
Sultan, what's one of your biggest winners thus far in your investing in junior miners career?
So I would say, I don't know if you can tell me, Bill, but I don't know if 2020 counts because everything was cheap.
Sure it does. If you bought in March of that year, good for you.
Yeah. And so one of my best, so junior resource stocks, there's two types of junior resource stocks. There's the ones that kind of start up from a, ground up, a good team gets together. And then there are the things that used to be up here that kind of dropped into junior territory. And that's where I like to fish. So something that I bought that did really well was a U.S. dry natural gas stock called Antero Resources. That, I think in 2019, it was probably about $6, $7. And I looked at it and I was like, I don't know about this. And as you know, natural gas has been a widowmaker for a lot of people. I don't know if you were in the sector when Amaranth was around. It was this hedge fund where the guy went all in and bet on natural gas prices. One of the first stories I covered at BNN, and the guy just blew himself up, right? I never forgot it. A one-way bet on commodity prices, right? So this eventually got down to about $1. And I didn't buy at $1, but I bought between $2 and $4. And more importantly, because it was a U.S. listed stock that used to be much more expensive. At this point, it was trading at about a $400 million market cap. I had added some options onto this as well. And so again, as it started to drop, I added in size. And then when it finally got down to about $1, I decided to buy the $4 call option 2 years out. And so eventually Antero got to $40. I sold most of my position probably in the mid-20s, unloaded the options shortly after that. So again, a life-changing return off of that stock. And there were a few others like that where 2020 was an interesting time because you didn't have to go too far down the value chain. Yeah, so Mega Energy, highly leveraged oil sands player, Baytex Energy, again, highly leveraged. These are all oil and gas. If we're talking about specifically about resources, probably Paladin Energy. Your viewers might know it from the Langer Heinrich mine. And so that would have been about a 10 to 12 cent stock on the ASX. I remember calling up TD Waterhouse every Sunday, talking to a gentleman as soon as the Australian market opened, and putting in that trade and making that trade in real time. And that was a stock that I think I sold the last of it last year, probably in the 60-cent range, but I sold most of it in the 80-cent range. And I think what those had in common was, mining for value off of the balance sheet as opposed to mining for value in the ground. Understanding that if the commodity price turned the way I thought, the debt would get paid down quickly, and your enterprise value is going to shift from the debt side to the equity side. And that kind of minimized my risk because I wasn't worried about drill results. I wasn't worried about, management, management issues. To me, that was a simpler way of approaching it because I had some previous experience doing it. Not for everybody. And I also had to know, because I've had times where that hasn't worked out. Okay, they've got out over their skis. It's too late. And I have to cut my losses and move on. And I would have been prepared to do that but in those cases, those are probably some of my best winners. I'm sure the next question is about some of my losers.
Yeah, and, let's hear it. But before we go to losers, Sultan, when you do the net gain on your biggest winner, what was it, 20, 30x?
Probably about 40x when you
40x.
Include, yeah. That would have been Antero. Paladin obviously is a junior mine. I'm not going to use leverage to buy junior mining stocks. Antero was kind of a unique case because there were call options available, liquid call options that you could buy. In that case, the time value worked in my favor. I was willing to pay up a bit for the time value because I wanted the time for this, this thesis to play out. Options are not something I'd recommend for most people because the time element adds a third variable. If you're going to use options, then you have to, in my opinion, you have to pay a premium for time in order to let your thesis play out. And none of us gets it right, and the stock doesn't know that you own it because a short-term option is essentially gambling. A longer-term option, usually 2.5 years, that at least gives you time for your thesis to play out. And I looked at the option as, okay, well, if it goes, I'm buying it for 60 cents. If it goes to zero, I lose 60 cents per contract. That's fine. If I bought the shares, at say $3-4 or something, and I'd sold it at $2, I'd probably losing about $2. So in that case, I probably leaned in and probably bought a few more contracts than I should have. But ideally, if you're going to use contracts and you're using that to replace buying the stock, then you should be putting less money up to do that. So your absolute loss should be similar. And in that case, if that makes sense.
It does. And I'll point out that Dave Lotan, a strategic resource investor, he views junior mining stocks as inherent call options to where it's a race against dilution versus value creation. So why buy a call option on a call option? That's too much too much leverage.
Yeah. And there was obviously some infrastructure around Antero that was already in place. So there was some replacement value. I kind of figured that my worst case scenario there was a recapitalization of some sort that, at $1, I wasn't losing too much, right? And I thought the idea of a zero was off the table. Some people probably vehemently disagree with me who were probably in the stock at the time. I think with traditional sort of junior mining stocks, like we're talking about like Paladin or something like that, then, I'm not a drill person per se. That's just not my area of expertise. So the philo minings of the world and that sort of thing is just not something where I can compete and win. And if, so where am I going to compete and win? What's my competitive advantage? If I put my money into drill stocks early on and I got my money taken, right? And I vowed at that point, never again. And I was only going to compete where I could win. And it doesn't mean that I've never bought an exploration stock. It's just I know what I'm buying going in, and I know where my disadvantage is. So I size the position accordingly.
That's excellent. What about some of your losers when you thought you were going to get it, but you were wrong? Or it didn't work out, management blew it up, whatever the case.
So, I think in the beginning, stock that shall remain nameless. And, I got a tip from a friend who put me into a stock that was drilling in the Golden Triangle. I didn't understand anything about. So I put some money in and it went up on the first couple of drill results. Oh, this is great. This is so easy. I should totally do this, right? Why was I buying TSX Venture rollups and doing all this hard work? This is great. And then the next set of drill, I woke up one morning and stock is down 40%. I didn't understand why. It's like I realized how little I actually knew because another set of drill results had come out. Bill, I couldn't understand what was on the page. I didn't understand what was different from the first set of drill results to the second set of drill results. I didn't understand what happened. I went on the chat boards, and I was like, that didn't give me any useful information. I'm going to stick it out because I had already purchased it. And if the next set of drill results are good, I'll get back to my cost price. All the things you don't want to hear. And what I learned later when I talked to somebody who didn't know was, that management team, they, what's called twinning the drill hole. They had already knew what was down there. They drilled it again, stock popped, sold some stock, live and learn. And what I learned out of that was I had to understand what I was doing. So that was probably my first loser, which shall remain nameless. It's still a publicly traded company. I'm going to mention some names here, and just so that I think it's more illustrative. A stock that I owned that eventually went bankrupt. I actually ended up making money on the stock, but it was pure dumb luck. And it's a stock called Three Valley Copper. Three Valley Copper is, do you remember the old Sprott Resource holding company that they had back in the day? It was something I'd been tracking for years. And it's spun some interesting assets at a Corsa Coal, still publicly traded, In Play Oil, still publicly traded. Eventually they got rid of all that stuff and drilled down to what would they then call Three Valley Copper, which is a copper deposit in Chile. I did my due diligence, highly levered balance sheet, which is something I actually like. A lot of infrastructure in place that would be hard to replace. Talked to some people on the ground who said, these rocks they're interesting. There's something here. And I thought that they could thread the needle. Where I made my mistake was position sizing. I sized the position way too big for what it was. And when I talked to the CEO, very nice fellow, he's not there now. He had no experience. He was a financial guy, no experience on the ground. Now, he did hire a geologist who I was told was very good at his job, and a mine engineer who was very good at his job. And I think the mistake that I made there was position sizing. I only got out because there was another investor who was prominently in the stock who, after the first set of results came out and it was not great, essentially said he was buying more, and it kept the stock high enough for me to get out. If that didn't happen, I would have taken a huge six-figure haircut. And
sometimes those guys tell you they're buying more and they're selling at the same time. I know you're aware of that, but
yeah. And so again, what should have been a large, substantial loss turned into probably a 30% gain. And but you have to do a postmortem on any kind of investment that you make, and there's no way with any intellectual honesty I can sit here and tell you that was a successful investment. That was me getting lucky. And again, the problem there was position sizing, and then understanding the rocks in the sense that people that I trusted had told me that the rocks were there. What I didn't account for was just the ramp up of the mine, and that the mine itself was going to be pulling ore out of the ground that was maybe not where it needed to be, considering where the balance sheet was. With a clean balance sheet, maybe they could have rode through it. With a very unclean balance sheet, we'll call it, there's just not a chance. As of today, I believe the Minera Tre Valley, the TBC deposit, is owned by the people who the debtors, essentially the lenders now own the deposit. Something that's currently publicly traded and just didn't work is Mako Mining. I'm sure you're familiar with it, the
Yep.
mine in Nicaragua. I'm disappointed in this one because, in my mind, the management team did everything that they said they were going to do. I think the issue here for me was not understanding that deposit size matters, and
not just grade.
Yeah, not just grade. Jurisdiction matters, and deposit size matters. And again, to be fair to the CEO and the company, they've done everything that they said they were going to do. They're they didn't define a resource. They're pulling it out of the ground. They're generating cash flow. They're doing all the things that they said that they're going to do. The market's not going to give them credit for it because there's not a defined resource there. And as long as people don't know what the size of the deposit is, it looks like it's going to run out in 2 years. And that's just not something that people are willing to fund. Obviously, we all know the problems in Nicaragua. So when you're dealing with a small single asset company in a sketchy jurisdiction, to be diplomatic, that's just too many things to overcome. And you can have the best management team in the world. It's just, there is just no way for that stock to re-rate, in my opinion. And while they are doing things correctly, in terms of developing the deposit and generating cash flow, there are just some things that kind of I should have paid more attention to. And I think in retrospect, my mistake there was averaging down and not waiting and seeing how things turned out. And so took my loss and moved on. And I think the lesson there is, if the thesis doesn't work, I feel like I assessed the risk correctly, but I didn't get out right away when the thesis stopped working. I should have sold as soon as the stock didn't move with certain results markers. And I think the last one that I'll talk about here is Salazar Resources. Bill, you're familiar with El Domo and sort of the issues around that deposit in Ecuador. So I had made a determination that the locals on the ground, the CSR, wasn't as bad as it was being made out to be. Reasonable people can debate whether that was correct or not, but that was my assessment. And
based on phone calls per your due diligence process?
Based on talking to people locally. And also to reading media, or Spanish language media. Two things that I missed. Guillermo Lasso is deeply unpopular, and he was pushing through mining and development. When I ended up trying to sell that stock when he was sort of booted out of office, and now there's an election going on. What's become clear is the sort of Indigenous Confederation down there is a very powerful political bloc, and these controversial mining projects are a political football now. And my opinion of the local support on the ground for El Domo doesn't matter anymore. Because there's a political aspect to this, like favor trading, or you support me, and if you want to support me, you're going to support my agenda. And in this case, the agenda is making sure that this mine never gets built. So this has become a binary bet on whether there's going to be a permit later this year. And in the size of that position, a binary bet, no, absolutely not. It can't be sized that way. So I made a couple of mistakes here. I sized the position too big for the liquidity in the stock. Getting out was very painful. I still own about 25% of my previous position, and that's what I'm comfortable with, considering, the risk involved. Ecuadorian sort of Spanish language media, I did the best I could with that, but what I failed to understand is national media is different from local media, and I clearly underestimated the local opposition to the mine. And I think I did that because when I talk to people on the ground, you have to rely on primary. So if I'm going out to cover a fire, Bill, I'm tasking you, what did you see? What happened? The who, what, when, where, and why. I'm not asking your opinion on fires in general, or the police department, or fire retardant foam, or any number of other factors. And I think I maybe let the people on the ground, their macro opinions kind of color, instead of just relying on their first party recollection. So my mosaic was skewed. And so I did not size the position correctly. I misunderstood the risk reward there. I thought I was buying something in the 10-cent range that could be worth 60 to 80 cents. I figured my downside was 5 cents, and unfortunately I was correct. My downside is 5 cents, but I didn't expect to hit it so quickly. So, and it happened. And I think the worst mistake I made there was, again, averaging down. I should have, when the first signs of Lasso being in trouble were there, I should have at the very least held. And so I think 3 different ways to make a mistake in the mining sector, I've made them all. And we could probably fill a whole podcast, Bill, with various mistakes that I've made. But can
you summarize the top thing to watch out for new resource investors that are just getting into this?
Yeah, I think do your own work. And write it down. Yeah, you have to write it down, because if you write it down and you understand why you're in it, what could go wrong, look at the facts, look at the patterns, and see what doesn't fit. And see what doesn't fit can mean either the stock should be higher than it is today, or the stock should be lower than it is today, or in most cases it's accurately priced. But if you write it down, when something goes wrong, you can go back to that and say, okay, these are the 3 factors that I need to go correctly. something's happened, does it factor into my 3 factors or 4 factors or 5 factors, whatever it is? If you do that, then you have a better sense of when to average down and buy versus when to sell or when to, okay, I need to hold here. And for me, a lot of the value that I get out of Twitter is that it acts as a real-time journal, real-time check. And so and also, unlike the book that I have here, the
So
Staples.
do you do it for your own purposes more than trying to communicate with others? Your Twitter account is your own journal?
My Twitter account functions as my own journal. That's what it started as. Now it's turned into something else. And mining Twitter has opened up a whole world to me that I didn't think was possible. Like I was saying to you before, Bill, like I was on the radio in Toronto. I did national TV. I get recognized more for my Twitter account than I ever did.
Is that good or bad for your ego?
Yeah, I don't know. And it's, and people recognize the name. I guess the name is pretty unique. I get people reaching out to me, and it's helped grow my network. And so I get something out of helping, if people get value out of my Twitter account, and I'm grateful for that, because I've gotten way more out of it than I put in. And it started off as a way to just get opinions on things, temperature checks. Then it became the sort of real-time kind of notebook on certain positions. I can't obviously tell people before I buy it and things like that. But I probably have a string of DMs, 100 different DM strings with various people. And some of them are retail that are just really sharp. Some of them are clearly hedge fund managers, and some of them are quite, CEOs of publicly traded companies, right? And I wouldn't have that network if I wasn't on Twitter, and I'm grateful for it every day. It's made things a lot easier. Ideas come to me now. I don't have to go sifting through CDAR.
A great point. What commodities are you bullish on? Could you give us a snapshot of your mindset here?
Yeah, I think soft commodities are interesting to me, just based on what's happening in Ukraine.
Like the grains, then?
Yeah, the grains. Wheat in particular. I'm still trying to figure out the best way to play that, and there is a bit of a ghoulish aspect to it. We're seeing a country be demolished in real time, and that's not great. It's not. I go back and forth about that because it's not something I feel good about profiting from, but it is the reality. The Arab Spring happened because grain prices went through the roof and people couldn't afford to eat. I think at a minimum, something like that's going to happen. So the knock-on effect when you have your 4th largest grain exporter in the world essentially shut down, possibly forever, because the infrastructure is being destroyed. Well, other countries are going to stop exports of food in order to keep it inside the country. So there's going to be this knock-on effect. So to me, figuring out a way, I don't necessarily play in the futures market, so I don't necessarily want to buy wheat futures, but how do I express that view? It seems to me that fertilizer might be a way to do it. I'm still researching that, but something to do with soft commodities and probably fertilizer is something that seems interesting to me right now. Something like copper, I think the bull case on copper has been done to death. But for me, it's more about industrialization and electrification. It's less about electric cars, and it's more about just, the things that we need in North America if we're going to reindustrialize, right? And lithium is not a thing that I invest in. I just don't feel like I have an edge there. What little I know about lithium and batteries as well is when commodities become too expensive, smart guys like Elon Musk will figure out how to replace them. Copper, nickel, those are the things that you kind of know in a car are not going anywhere, right? They're sort of foundational to the battery. So copper's another one. I think some of the others are probably that I think are interesting are probably not the common ones that you'd hear. Like I know that hot rolled copper coil steel is a finished product, but if you think about it, the United States, if you look at the U.S. Steel, for example, they're just printing money right now. I own something called Algoma Steel. In my opinion, it's not run by the greatest people, and it's a de-SPAC, but I think the U.S. is structurally importing. They're kind of in a situation that they structurally import steel. I don't think they can produce enough internally. That seems interesting to me. I guess what I would say, Bill, is it's less about the commodity. It's how can I express the view in a way that's going to make me the most money. And you and I were talking offline about uranium, and uranium is a good example of that. Am I bullish on uranium? Kind of. I'm not bullish on uranium that I want to buy junior mining stocks. I want to be in a different part of the value chain. So I don't know if that really answers your question so much. It's less about the company and more about how I'm going to express that view in a way that's going to turn a profit for me at an acceptable rate of return. I can tell you there are some things that I'm not particularly bullish on. I'm not a silver bug. I just think the way streaming works and byproducts work, that I think silver is more of an industrial metal, and there's just too much of it out there, and there are these forced sellers in terms of streaming contracts and this sort of thing. So I'm not a $50 silver guy, and I'm going to hope, please don't send me any hate.
Don't worry, some people will flog you for that.
Yeah, I'm sure they will. I'm also like, I don't know how to express this in a way that's going to get people angry at me, but I'm not a $200 oil guy either.
What about 140 though? Can you give me 140?
Yeah. So if I'm going to express that view on oil, like I think.
But you invest in oil companies, right?
I do invest in oil companies, right? But again, so I just recently sold Meg Energy, and that was a deleveraging story, right? They deleveraged. It went from where I bought it. Some people bought it as low as $3. I bought it at $8, $9. It's trading at 24 today. But I think it probably trades in line with oil going forward. And I'm just not seeing $100 oil. Gas is expensive, but oil's at $80. And I think that probably has more to do with refinery capacity. And so maybe refineries are the way to go. The refineries are printing money, right? And so being bullish on a commodity doesn't necessarily mean you have to buy the producer of the commodity. I think there are some people who are going to do very well buying I don't own any refiners, by the way, but I think there are some people who are going to do very well owning refiners and have done very well. I'm sure you've heard the same people that I have talking about Tidewater and offshore. I'm sure they're going to do very well. And again, that's a post-bankruptcy play.
So do you study and look for more of the post-bankruptcy plays, even more so than timing a commodity turn?
Yeah, I think it's a combination of both, because if you get the post-bankruptcy play right and you get the price of the commodity correct, wonderful things can happen, right? And so if I had gotten the natural gas cycle wrong with Antero, that's a much different story than going from $1 to, $4 to $40. That's $4 to $1. And those options are expiring worthless, right? So you do kind of have to get both correct. And it's there are simpler ways to make a buck. That's why the risk return has to be there, because I can put my money in a bank stock or an index fund or something like that, and make pretty close to a double-digit return over the last 10 years. So if I'm going to take a lot of this extra risk and have all these moving parts, then the return has to be there. And I think that's the thing that people need to understand, that there's any number of ways to make money in not just mining stocks, but in the market, and you have to find what works for you and drill down on that.
Sultan, before you go, any other names you like right now that you could share?
Yeah. I'm a big royalty guy. I think the royalty model's been, I don't think you need me to tell you about the wonders of the royalty model, but I like Elemental Altus. It was created through the merger of Altus Strategies and Elemental. Elemental kind of came onto my radar when Gold Royalty made a hostile bid, and Fred Bell, the CEO, he really impressed me. Just I'll keep my opinions on Gold Royalty to myself, but in my opinion, he did a really good job explaining the value prop, and he convinced me. He made a believer out of me, and so I ended up buying some stock. I had already, and then when they bought Altus Strategies as a merger, I ended up buying a big position in Altus Strategies, and I looked at that. Now they've been buying, increasing their royalty on Caserones, the big copper deposit. So it gives you a nice way to play copper. There's about 9 or 10 other, probably 9 other producing royalties. But I think the big value here is if you go back and look at the press release that came out last week, that Altus portfolio of African assets, pardon the pun, is a gold mine. There is a lot of value there. There are 6 Egyptian assets that could probably be spun into another company. There have been others who have talked about this. The Matt Geiger, I think, puts out a letter where he's kind of walked through these assets. So if people want more information, you could probably start there. But I think the Altus portfolio is going to generate a ton of value. The deal that they did last week, and I know these are places like Mali and Burkina Faso and Egypt that are not traditional places that people tend to want to go. But, the good thing about royalty companies is cash flow is valued at a high multiple, and, you don't necessarily have to run the mine. I've done pretty well investing in certain parts of Africa. I owned Orca Gold before it got taken up by Perseus Mining last year. And I think people looked at it as Sudan, but if you kind of drill down and looked a little bit closer, what I was told and what I was able to verify is that deposit, that block deposit, was actually just over the border from Egypt. And Egypt is considered very good virgin territory to mine. I'm sure you've heard about Arabian Shield, which
Definitely.
is also...
My second sponsor was Antero Resources there in Egypt.
Yeah.
So, yeah.
Yeah. So it's, I think there's a lot of value there. I think Egypt is incredibly valuable. I think that Mali royalty that they just created is going to be incredibly valuable. What's a 3% royalty worth? I don't know. Is it on a project level? Is it equivalent to what? Owning 20% of the project, 10% of the project? I don't know. Reasonable people can come to a conclusion, and you don't have to put another dollar into it. I think the other thing that I liked that I realized from the Perseus deal was Africa is probably the easiest place to get a mine permitted and built quickly, and the grades are good, and you can make a lot of money doing it. The other thing I took out of that was, even though there were problems in Sudan, nobody was going to mess with that mine because everyone needs US dollars to come in. And so I think the risk of nationalization in certain instances is overblown. And Africa, like any other place, is not a homogenous region. And the same way you wouldn't invest the same way in Arizona as you would in Nevada. Very close, not the same. And I think if you're willing to do the work on Elemental Altus, I think you'll find something that you can buy, put away, and eventually turn into a nice little cash flow machine. Something else that I like is I was trying to come up with a variety of kind of names here that kind of cover the gamut. One that I like is Antero Resources. This is a greenfield exploration, so please don't put your life savings into it.
So you do exploration here and there.
Yeah, position sizing.
Yes.
This I like for two reasons. I like the guy in charge. It's greenfield exploration. I don't know if they're going to find anything. It's in a nice area. They're partnered with South 32. They're drilling in part of Argentina that's very hot right now, the San Juan province. But talk to Ruben Padilla. Very impressive guy in my opinion. This is a bet on a man. It may or may not work. Obviously, the rocks have to be there, but he's got a nice big piece of property, and he's going what he calls elephant hunting. There are nice people in this sector. I'm willing to give him a little bit of money and see how he does. And but like all things, the balance sheet kind of has to be there. I don't think it's going to get diluted anytime soon. They have two royalties that they can sell to finance. They've got a lot of cash, so you're basically trading at a zero enterprise value. So you got a lot of runway to see if the thesis plays out. And so if he does a good job, that can be obviously good drill hole. I mean, what's the ending of your show? A good drill hole can
produce $1 billion. Ross B said,
$1 billion, right?
And it's outro.
Yeah, and it's in a good part of the world for that sort of thing. And then I think the last one is one that I like. I have a full position in. Not for everybody. It's I'm a sucker for aggregates. I'm a sucker for that crushed stone, anything you can use in construction, because if you kind of think about that intuitively, you have a monopoly in that area, because the price to truck it kind of determines that they have to buy from you, and they can go somewhere further away, but as long as you price it properly, they can't go further away. And aggregate is aggregate, right? And so Vulcan Minerals isn't exactly aggregate, and this is Vulcan Minerals, not Vulcan Materials. It trades on the TSX Venture. It's a prospect generator that has generated spun out Atlas Salt, and Atlas Salt owns a large salt dome. Salt is used for a variety of things. I'm going to give you a big, so obviously you put salt in your food, you put salt on the road, but salt is also an industrial input. It's used for polyester, it's used for plastics, it's used for all kinds of things. There's the Goderich mine in southwestern Ontario, underneath Lake Huron. That's the big producer, but structurally in North America, we import salt. And so where this Atlas Salt deposit is, it's in Newfoundland. It's in a place where work is hard to come by, so high value jobs. I I suspect the thing gets built personally. And more importantly, it's on the water, so you can transport easily. And so I think it has the potential to, and the company kind of goes through this, has potential to disrupt the sector. They produce cheaper than Goderich because they're not going as deep down. So what does all this mean for Vulcan Minerals? Because Atlas Salt is a separate company. Well, Vulcan Minerals owns 33% of Atlas Salt. That's worth about $45 million. The market cap today of Vulcan Minerals is $22 million. Well, what about the cash burn? You say, well, Vulcan Minerals has last time I checked, about $6 million in cash. So it can run for a while before it has to dilute. Like any good prospect generator, they were able to keep royalties on the salt deposit. So it's a 3% royalty on the Atlas deposit. There's also a 3% royalty on another company or another deposit that's in another company that's also going to be spun out called Triple Point. They're going to own about 10% of that. I figure that's worth about $3 to $5 million. And those two royalties themselves probably worth about, ballpark it in my head, we'll call it $40 to $60 million. And obviously what's the risk here that that salt mine doesn't get built or that the price of salt collapse? I don't think so. It's pretty stable over the years. And so we're in a market where I think you'd agree we're not in a bull market for resource stocks, but this is a good time. If you know what you own, you can slowly accumulate good assets that will pay you down the line tenfold. And I think this is a case where Vulcan Minerals, if you're, whether it's K plus S or whether it's Compass Minerals or somebody's going to end up buying this deposit, but that shouldn't be the be all and end all, but I think that's probably your base case. If that happens, it makes sense to not just buy the deposit, but to buy the royalty as well, because salt mines last for hundreds of years. So if that happens, a stock that you can buy today for, we'll call it somewhere between 19 and 22 cents, I don't know, what's that worth? $2? Possible. 150? Possible. I think my base case is probably 10x. And so I'm going to put that money in, a full position, knowing that could get cut in half or go to zero. And by the way, it's a prospect generator. They've also got some very prospective properties and other things that are optioned out. Gold deposit, properties with some prospective gold, prospective nickel, copper, so I think there's a lot of ways to win here. That's the kind of stock that I want to own in this market. Just a lot of assets that I can buy, particularly cheap. It's not a good market for buying recaps or buying things with balance sheet issues. But this sort of thing, these are kind of companies that I can buy and kind of hold and not have to worry about the balance sheet blowing up, which is kind of my general base case when a lot of times when I'm buying something with a financial distress on it.
Sultan, thank you for sharing those names and why you invested. Before you go, Consolidated Rock Holding Company, that's your company, and your website is consolidatedrock.com. What will investors find there?
A lot of out-of-date material. I will endeavor after this podcast to do my best to update that. What Consolidated Rock does is it's basically functions as my personal holding company, and I use that to partner with other people to make private investments. And so what I own right now is, and hence the name, is it started out life as a roll-up of rock quarries and aggregates, and that did okay for me. And that right now I own a piece of a frac sand royalty, and that's actually taught me a lot about the royalty business. It's not as easy as they make it sound. It's yes, it's a check cashing business, but you also have to make sure that you're being told what the proper volumes are. How do you do that without somebody on the ground? What's your legal recourse? It's been a very interesting education in not just the frac sand market, but also in how royalties actually work and the value of a good company. So the assets matter, but in a royalty company, you're really investing in the asset allocation skills of the person in charge. So Consolidated Rock is sort of my private holding company. It's allowed me to make investments that I wouldn't otherwise be able to make. I do okay, but can I write a 7-figure check tomorrow? Well, that might be a bit of a stretch. So and if I'm going to put that kind of money in, probably prefer to do that in the public market right now. So that's sort of what Consolidated Rock is. I think for most people, my Twitter account is probably where I'm most active and where they find the most relevant information. That said, there's a contact me form. That's how you and I got in touch. I try to respond to as many emails as I can. The only thing I ask is, please don't, if you have problems with my stock picks, please talk to Bill or something.
Yeah. Right. Take responsibility for your own decisions. Like, this is for information purposes only. You take the information and apply it with knowledge according to where your financial situation is. Right, Sultan?
Yes, absolutely.
Yeah. All right. Well, I really appreciated this conversation. It's been great chatting with you offline and online via this recorded podcast. So thank you for coming on the show today, Sultan.
Thanks so much, Bill.